Hello, welcome back, guys. So many people were asking me to take a look at Roku and talk about the stock, which has been down about 23% since its earnings report. It got absolutely devastated after reporting, and overall, it's down about 85% since its 1 year high of 400 plus bucks, which is absolutely insane here. The company has been devastated. We have talked about this company a few months ago, where in my latest video I talked about how very expensive that was, and it looks like it's following through by pretty much going down every week or so. Now the company's financials are still expensive, even though again the stock has fallen off a cliff. You will see that it's pretty much going down and down and down and down, and still we're looking at a P ratio of 88 over here and a price to free cash flow of 47, which is super high, especially again after the company has fallen down quite a bit. Now let's take a little bit of a look at what has happened with the earnings report. So it's plunged 23% after missing earnings. So what happened here? And also got some downgrades, some very interesting downgrades here, so some steep ones. From neutral, Roku shares Friday to neutral is what was downgraded and slashed the price target to 70, mind you, from 200 bucks. Okay, so what happened here? The company posted earnings losses of 82 cents per share and revenues of 764 million, which both of these were below consensus estimates here, as pretty much all the ad and device sales for Roku remain under pressure here. They have also issued a third quarter forecast that's 200 million below expectation, which is another very steep decline here that was unexpected. I guess you could kind of expect that, but it definitely brings the stock price down. And of course, as I talked about earlier, there was a downgrade. Shares were downgraded to neutral and slashed from 200 to 70 bucks. And of course, the company has said that they continue to view CTV as the next leg of growth in digital advertising and all that jazz. But the fact remains the company is down quite significantly here, and they have lost a lot of their value. Now, the problem is not so much that the company has lost a lot of its value, as it is that it is very expensive still. And even though they have been growing nicely, through the years, people actually bought too much of it, and they brought the price way too high, much higher than it should be. And even after an 85% loss, again we're looking at P ratios of like 80 and price to free cash flow of 47 here, with outstanding shares also going higher because the company has been buying back shares, has been issuing shares, and so these are all bad signs to see for the company. And of course their equity grows because of all this issuance. Now the net income margin is negative because the company is losing money, the same with the return on equity here. The only good thing is probably the fact that the company doesn't have much debt here, but what I want to see is what they have been doing in terms of their financials as a holistic view here, from 500 million to 2.7 billion over here. So they are growing, and that's definitely a good sign. But you also want your company to be cheap when you buy it, and growth is amazing, but you have to be buying it for a good price. And so you will see here that the net income has been marginal, 242 million. Now it's a good thing that the company's net income has been going into positive territory, although I'm not sure that will continue for the upcoming years or so. But at least the company has been growing in a positive manner. So this may be a company that is worthwhile buying, but it's never worthwhile overpaying too much, because when you overpay, you are more than likely going to get hurt in the future at some point, and the company could underperform for your investment for many years just because you overpaid. So you want to avoid that. And in terms of the balance sheet, the company's total liabilities are sitting at 1.5 billion with a total equity at 2.8 billion over here, so about double of what their liabilities are. But the liabilities are sitting at $1.5 billion here, and the cash flow statement, you can kind of see that the company's free cash flow was like 188 million last year, which is too little compared to the market cap that the company has, and you can kind of see that 188 million. If we go back to our metrics page here, you will see that the company's market cap is sitting at almost $9 billion. So how does a company that is valued at $9 billion making $188 million a year sound to you? Does that sound like a great investment at this price? it's the multiple of the free cash flow compared to the market cap is way too high. It's like 90 or something. Compared to the market cap of the company here is very, very high. And this is problematic. I mean, this is something that you definitely need to take into account when you decide to invest in this company. It's not really 90. I mean, we can do the math here so that you see that. You can kind of see how this gets calculated over here. As you can see, it's 8.9, and if you divide it to 188, which we saw earlier is what the company's free cash flow was last year, you will get 47. If you multiply that by 100, of course, you will get 47 for its price to free cash flow, which is very, very, very expensive multiple to be buying the company at, is the thing. You want something that is much, much less than this in order to be able to reap the rewards in the upcoming future, really, in the future. And so you will see here that the company's operating cash flow has been doing a little bit better. In terms of investing activities, it's some capital expenditures and some acquisitions here for the most part. And in terms of financing, the company is getting some extra debt, it looks like. And actually, it's not really getting debt, it's issuing common stock, which is probably even worse than debt, really. I said both things are bad, but the company keeps issuing stock here, diluting shareholders. So it's something that I would hate to see as an investor in the company myself. So things are not looking great here for the company. And again, this may be a good company, to hold at a cheap price, but at this current valuation, I just can't see how somebody would buy this one. Now, the insider trades, you will see here that there is some stuff going on here, some for the most part, some selling you will see. And I would say that's that's kind of normal. It's like awards here pretty much. Remember, these are what the insiders get awarded for working at the company, really, so it's part of compensation. Now, there is quite some steep selling, which is worth noting, though, because they are selling big batches of stock. So it's like 3K here being sold. This is how much they owned, and this is how much were transacted. So they are selling pretty much all of them, so they're getting rid of all their percentage, like 100%. So that may be a little bit of a warning sign potentially here. Okay, so in terms of senators, there was just one trade that I saw here. Just this one pretty much happened in February 10, 2022. It's the latest one, a small batch here from one of the senators, but other than that, there's not much action going on. Some sales in the previous quarters, I should say here. But again, this is like more than 6 months ago. Okay, so the next thing that I kind of want to see here is, of course, take a look at our stock evaluation tool and decide what kind of price to pay for this company, if there is any price really. And the thing is, the revenue growth of the company has been pretty high, yet we cannot really go that high because it looks like we're getting some sort of a suppression in terms of what the company has been doing and will be doing in the future. So we're gonna go lower. I'm still going to go high because this is supposed to be a growth story, and I'm willing to concede that the company could be doing well in terms of growing their revenue in the next few years or so. This is like a 5-year model here. In terms of net income margin, it has been all over the place. Lately, it's getting to positive territory. So I'm gonna be using positive numbers, and I'm gonna go somewhere in between all these 3, 5, and 8, and see what I'm getting out of these. Again, these estimates here are very, very actually aggressive. But okay, again, we are doing that just to see what kind of projections we're getting for all these different potential scenarios. Now, in terms of the free cash flow margin, I'm gonna go 80, 90, and 100, which is rather typical. The company hasn't been achieving that, but as you can see here, pretty much overall. But I'm willing to just try it and see what I'm getting out of the company's projections here, because I know that I'm going to be witnessing something that's too expensive already. And an annual return that I'm going to be getting is 13%. I hit calculate using these values, and you will see here that not even our high is actually there. Our current price is sitting at 65. Our highest estimate, which is very, very high and very confident here, is still about $53. And so right now, there's no way I could be buying this one. It would have to be way lower. And frankly, I'd say that it probably has to be somewhere in the teens for me to be entering this company. Otherwise, I just don't see enough value there. And I would probably just avoid that altogether right now, even though it has fallen off a cliff. You'd have to go back to sort of like the irrational exuberance phase where people were buying everything and anything, just to get this stock to move higher. It just doesn't seem like there is any value here yet. So I would have to avoid that and pretty much not follow what Cathy Wood has been doing, which we can kind of see here. ARK Invest's flagship fund falters and amid broader tech rally, as you know, everything was up like 4% because of holding Roku and Teladoc. The fund actually was like down that much or something of that sort, just because they were holding all this. It fell more than 4% a week, while the Nasdaq surged nearly 4%. So yeah, they were absolutely devastated because they were holding all these stocks that and companies really that are just not making enough money to be sustainable here and make any sense for their stock price. Thanks for watching the video. I hope you enjoyed this one. Please remember to leave a like and subscribe, and I'll see you soon. Bye bye.